Kevin, where are you trimming? What have you reduced?
Well, just equities across the board in terms of our tactical positioning. It's kind of a short-term view, and it's not a bearish view on the economy or the outlook for 2021 as much as the fact that momentum can't continue on indefinitely. We've had a very strong improvement in terms of expectations. It's priced in, and consequently, our own barometer, which we use to kind of gauge the next 3 or 4 months, is flashing some warning signals here. Consequently, we reduced stocks broadly, let's call it the S&P 500, and we add to bonds. Still overweight, but less so than where we were at the start of the month.
So you've taken things down to the index level. Can you help me understand the bond allocation, Kevin? Where on the curve, where in the bond market? What are you looking for?
Sure. Well, we've shortened up durations. We've moved up the credit quality spectrum. We're just not seeing any real reward in terms of going out the risk. We're not being compensated out the curve to incur more risk. And in terms of lower quality credits, we've seen a big tightening up of spreads in credit markets. We just don't think we're being paid there. So we've kind of taken some risk off the table there. We're just going to wait for a better entry point, kind of husbanding that portion of the portfolio in cash like surrogates, and then of course in the intermediate investment grade government corporate part of the market.
Kevin, this is why this is tough. Your business is tough, and I certainly don't sit here and think it's easy. You could have said what you just said 3 months ago, could have said it 6 months ago, could have said it 9 months ago, could have sat here together and said, I'm not being compensated for the risk I'm assuming. Why is now different?
Well, it's different. Well, first of all, we didn't say that back then. We did have a different allocation 6 months ago, 9 months ago. But things have changed, and we're seeing different things in terms of momentum now also in markets. We're seeing that the Treasury bond, which has begun, the yields have begun to move higher. We've got some negative momentum there. We're just not seeing we're not seeing the economic conditions to support lower bond yields. So things have changed a lot in 9 months. If you went back and looked at where we were in the beginning part of last year, our barometer that I just referred to before, that was actually deteriorating, and we had to change our tactical outlook as a result of those facts. But the facts are now changing again, and what we have are some just very strong numbers in terms of earnings, big surprises this quarter, but it's priced into markets since we've had a $33 trillion increase in global stock market values in the last 9 months. So things are changing all the time. We have to think about valuations, how we're being paid, and how the trends are evolving.
Kevin, what you pick up on, I think, is really important. Often there's more information content in not just the data, but how the market responds to the incoming data. And I think that's what you're touching on right now. What I'd love to know is when we get to the point in time in the next several months where that bite point gets just a little bit more stronger, because there's still a lot of people out there that disagree with you, that believe things get better, and they're forgiving of the downside surprises. They're forgiving of the economic data if it doesn't come in as expected. When do you think the broader bite point is for the broader market? You seemingly think you're getting out early, you're waiting for this pullback, but when do you think the reality starts to hit others?
The reality starts to hit when you start to have disappointment in the delivery of what markets are expecting. Just about every bear market has come to an end at some point when there is a disequilibrium between the expectations that investors are pricing into assets and what is actually deliverable. So at some point, there is a limit to how much earnings growth can ultimately be sustained. We buy in fully to this idea that we're going to move towards a pandemic world, to a post-pandemic world. At some point, that's going to make the real economy better. But at what price? There is a point at which you're just not being paid to take on the risk. And if you're not being paid to take on the risk, if markets can't deliver enough earnings growth to satisfy what is priced in, then you have to be willing to take some chips off the table, and that's what we've done in our tactical asset allocation portfolio.
And you're doing just that. Kevin, it's great to catch up. Always appreciate your view on things. Thank you, sir.